those in the network that don't know us, and I believe there are some, founded in 2003. We're a team of 5, 2 dedicated disciplines, small companies and emerging companies. 15 years, as Dom said, in the business. Our performance has been, well, put it this way, we're very happy with the numbers. For the year, the Emerging Company Fund has finished, 12 months to end of August, we were up 34%. And the larger fund was up about 29%, as Dom indicated. Great process, we think, and has got ourselves through some pretty tricky conditions. 15 years, we've seen quite a bit, as you can imagine. We all know we lived through the GFC. We had to navigate that space. Just quickly, page 4, a none too subtle reminder to the network about the value adding of a manager, having a small cap manager on the job. You can see the performance of the small ordinaries accumulation, $25,000 put into the benchmark on an accumulation basis would give you just under $65,000 from when we started the product 15 years ago. If you put the money in the 100, you'd have done slightly better than that, than the benchmark. You'd have done about $95,000 invested in the ASX 100 with dividends reinvested. But for us, the differentiator, of course, is the value add that comes with the right manager in the right space. The Eley Griffiths Group, 25 grand in, is today worth 132,000 in round numbers. So quite compelling. A bit of fun on page 5. We are bullish. Eley Griffiths Group does not always, as a house, run bullish, but we have in the last couple of years. This is a diagram that highlights when you have a market advancing from what we would describe as a cathartic give up, which we saw in October 87. That collapse in markets in 87 sponsored a rally that went for 13 years before it culminated in a high in 2000, the 13-year rally at a very, very stressed and depressed levels. If you interpolate or overlay that sort of rally on what we went through with the GFC, you can see we might just be in for a rally of that sort of size or that sort of duration. On that basis, we're 9 years through what could be a 13-year rally. Don't hold me to it, but would not be unusual for a 13-year rally to unfold. It's interesting too what we're going through here at the moment. In the US, you've seen a very strong reporting season. Going to finish this year with 22% odd earnings per share growth in the S&P. Great performance. Stocks seem to be disinterested or indifferent to that. What I'll remind viewers, those tuning into the morning meeting this morning, is in the United States back in 94 and in 1984, we had a similar situation. You had a very strong reporting season, circa 20% earnings growth. You had a collapse in emerging markets, just as we've seen, and you had fairly lackluster share price performances in those periods. The year following was an explosive move to the upside in the US stock market. So just quite eerie how in 2 prior periods when you have a similar setup, it ended up resulting in a very, very explosive rally the following year. So that might just backfill nicely on my 13-year rally scenario. Just to give you more confidence that the rally we have, whilst it is getting long, no one's going to argue here today from Eley Griffiths Group that we're in a young infant rally. We're quite a maturing rally. This rally that's been going for 9 years, in fact, has had 3 recharge events where we've actually had some nice little corrections along the way. All of that seems to get forgotten. But from the rally out from the 09 lows, you've seen 3 windows there, 2010, 2012, and of course 2015, where you had around just under 20% corrections across stocks in the US, which in the old almanac was described as a bear market. So you've had 3 bear market or corrected episodes in the advance. So we think that US market is in a good position to rally further. I'm going to hand over to David Allingham, who's going to conclude the final part of the presentation.
I guess just in that context, we'd look at the emerging markets as being probably the best opportunity we see at the moment, somewhat of a contrarian view. And this chart, I think, just looks and really highlights that emerging markets, China, the Shanghai Composite is off 35% since January. We saw very interesting trading yesterday. The Shanghai Composite closed up 2% on that actual trade data tariff being implemented. So we think that's a really positive signal for where that market wants to go in the next couple of months. And this just shows effectively when you see percentage of stocks above their 200-day average fall to only 28%, it's given 2 very good contrarian buy signals. And you can see that back in 2011, 2015, and you can see it there today. We're getting very close. So the point here is you wouldn't want to be shorting or betting against these markets that are quite oversold. And of course, this is just not another bit of a data fact. You can see here the green line is effectively the trade war count in Bloomberg. So the number of times trade wars being mentioned, you can see how well that's correlated to the deterioration in the Shanghai Composite. And of course, we all know who's winning this at the moment. It's the US and it's the Trump push. But we think as this green line, the trade war sort of count does start to sort of decline a little bit, we'll see Shanghai start to improve as well. So again, more thesis to this emerging market contrarian rebound we're expecting. So I guess in that backdrop, how do you want to be positioned for this at this point in time? You know, we've been quite bullish on the commodity complex. And if you look at this chart, we're stolen this from Jeffrey Gunluck. We generally drop into his quarterly webcasts, and this just shows that commodities versus the S&P 500 are as cheap as they've ever been, really back to the dot-com crash. So you can see here, and we all know what happened then. We had basically a seven or 8 year bull market in commodities. Now, we're not calling for that kind of bull market, but what it's really highlighting is there's great relative value in commodities. Resource companies are generating a lot of free cash flow. Their valuations are sensible. And we think even with the move overnight in copper up 3.5%, Brent's touching $80, uranium starting to rally off its lows, we think there's some great opportunities in the resource part of the market. That's where we've been hunting. I guess we wanted to leave you today with two key stock ideas. One's a value idea and one's a growth idea. That's how we look at markets. We're sort of style agnostic, so we can own value stocks and we can own growth stocks, and we think that protects us through the different phases of the market cycle. The first one here is a little bit contrarian. Platinum Asset Management, great business model. You know, this is a business with 28 billion in funds under management. If you're bullish equities, these guys are far more exposed and leveraged to their funds under management than their flows. Having said that, they're actually still in inflow, and we think some of the initiatives they're taking on the institutional distribution path offshore, with Care Nelson stepping back from day-to-day stock picking but getting out more on the road on a marketing sense, we think is going to be quite favourable for inflows. They've been reinvesting in their business development and staff, and critically, I think the reason we're so attracted to this stock is it's on a PE of about 16 times now. So that's about a 3 PE point discount to its average PE since it listed back in 2007. It's yielding 6.3% fully franked on its historical FY18 dividend. And I just had a look yesterday. I thought I'd have a quick. The stock floated at $5 back in 2007, so it's had about a 10-year listed life. It's paid out $3.10 or $3.09 a share fully franked, or $4.40 gross. So you've almost had your actual capital back in gross income in the last 10 years. There's not many stocks you can say that about. And that really talks to its free cash flow, its dominant market position. So I think that chimes in very well with the positioning around their positioning around emerging markets, their pro-emerging markets. That's hurt their performance the last 6 months. We think there'll be a big snapback there. And just like we saw back in 17, the stock went $4 to $8. We think this thing's really primed for an aggressive rally out over the next 6 to 9 months. The second one's, I guess, more of a growth idea, and I guess the risk proposition's here a little high because you're paying for a business that, 700 million market cap business that basically cash flow break even at the moment. But Nearmap, I guess 2.5 years ago, we would have looked at as a business that was, we didn't think had a lot of IP, was probably structurally challenged with the likes of Google Maps and Google Earth and so on. I guess what we've done since, we've done a lot more work on the business, and I think Rob turned up 2.5 years ago as a CEO, bought 5 million shares into Screens, and I think they've spent a lot of time on the IP. So if you look at the geospatial mapping space and their technology, we think they're at least 10 times more efficient in the amount of image capture they're doing globally versus the peer group and the leader in the market, EagleView. So they can run about 15 planes in the US at the moment to capture what they need to, about 3 shots of the US a year. EagleView have 115 planes to do the same. They've invested aggressively in 3D and oblique technology, which gives you more sort of horizontal views of buildings. And I guess the real differentiator, which we had not appreciated about Nearmap, is they're actually opening up this market. The way they're doing that is this has been quite a lumpy, CapEx-orientated proposition for the government agencies, roofers, insurers. It was quite capital intensive. They'd have to pay bespoke $300,000-400,000 lots to get the data. What Nearmap have done have made it a subscription model whereby these councils and insurers and roofers and solar industry players can pay a subscription fee, which has actually broadened the market. 80% of clients for Nearmap are new to the industry. They've never used these products before. So we think the industry is growing aggressively. We like the fact that they're in free cash flow generation mode, and we think the other geographical opportunities, both in Europe, the UK, and North America, are really going to underpin the share price over the next 12 to 18 months. I'd probably just conclude, before I hand back to Ben, the other sectors we like at the moment. I think mining services, which has been a very consensus trade for a couple of years. I think a lot of fast money's left the register of these companies in the last 6 months. You've seen a lot of them underperform, the likes of Emeco, Seven Group, Index, Mastermind, Alliance Aviation. Some of these stocks have spent 9 months going nowhere. And if you look at the industrials, their comparables in the US, like Caterpillar, John Deere, they've just started making higher lows. The trend's looking a bit better. We really think this sector's primed for a good 6 months, and it fits into this cyclical resources pro-risk on element we're talking to. So I think we'd highlight those names like Emeco, Mastermind as real very good investment opportunities at this juncture.